Mark?
Thanks, Jennifer. And thanks to all of you for joining us today for our third webinar update on PPP. We discussed it with you in May. There were a lot of things that happened between May and June, and so we had an update in June. And then we just kind of sat around and waited for what we hoped would be the final sets of rules. And after many weeks of waiting, said, man, we need to get out in front of our clients again and let them know why we're waiting and what's going on. So we sent out an update about a month ago via email, and then scheduled this call to walk through what we know, what it means for your business, and a couple of strategy or open question items, especially as it relates to the timing of forgiveness. So if you will recall, for those who were present for our June session, we covered 7 steps to maximize forgiveness. And just to make sure that those are fresh in our mind, we said the first thing that a business owner needs to do is spend all of the PPP funds on good cost if they want to get all of the loan forgiven. They also need to pay people enough, and enough was defined as a no more than 25% reduction in pay relative to Q1 2020 baseline pay rates. We had to pay the right number of people, and that got into our FTE calculations, noting that there was a giant loophole safe harbor, the gigantic loophole safe harbor, as we termed it in our last presentation, that mitigated the need to pay the right number of people for a lot of businesses. Then we said if there's any problem with 2 or 3, businesses can fix it by restoring wages or getting back to the right number of full-time equivalents yet this year. We discussed the payroll cap, which was the rule that said at least 60% of the amount forgiven had to be backed by spend on, I'm sorry, I said that wrong. That was our 60% rule for spend, and we had a lot of questions on this, so I want to make sure that I get the terminology right. So there's the rule that at least 60% of the amount for which forgiveness is requested needs to be backed by payroll. And then we put it all together and looked at the math of how it all fit together. And then we said, okay, we need to make sure we get the paperwork right. So those were our 7 steps that we said, if we navigate those 7 steps successfully, we will optimize forgiveness. And then we said, we are waiting on Congress to finalize a few things. Specifically, there were some discussions about possibly having automatic forgiveness for businesses with loans of a certain size. And we had talked about a question about deductibility. So now we're here with you today to talk about where things stand, because through the passage of time, many businesses have now completed or soon will complete step 1, and that is they've spent enough money on good costs to fully optimize forgiveness, to have the entire loan balance forgiven. They've spent all the money. That leaves many of them, especially those who know they didn't decrease wages and know they didn't reduce FTEs, or who maybe reduced FTEs but fit within the gigantic safe harbor that we discussed on our last call, where OSHA, CDC, and the like mandated a reduction in employees, or mandated rules that caused a reduction in employee count. And so we're having a lot of business owners saying, this has been fun, but we're ready to get off the roller coaster. We're getting a little bit nauseous, and we'd like to just have this behind us so we can start looking forward to other things. We've also gotten a lot of questions from business owners who are concerned about having potential issues with step 2. Did they pay people enough? Or step 3, did they pay the right number of people? So we're getting questions on both of those. So I'm going to kick it over to Jeremy and let him talk us through a little bit the best practices that we had reviewed to set the stage for what we know today.
Yeah, thank you, Mark. And the reason we thought it would be wise to maybe take a step back and look at this is because this process, again, there are a lot of concerns that we're hearing, and again, a lot of business owners that are ready to get off the roller coaster, as Mark termed it. And I think a lot of that concern is born from the fact that this entire process, generally speaking, has been one of urgency up to this point. At the beginning, there was a certain amount of urgency related to the application process because, again, it was a finite amount of money. There were concerns that it would run out, which it did initially, run out of funds. So there was an urgency about getting applications in, getting to the front of the line. There was urgency about getting the guidance as quickly as possible to make sure businesses were maximizing the amount of those loans and were getting the correct amount. And then once the loans were received, the urgency turned to, okay, we now have 8 weeks. We're in the middle of the pandemic. Businesses may be closed or may not be operating at full capacity. There was an urgency in how do we use these funds as best as possible and as quickly as possible in the manner in which they were intended so that we get full forgiveness associated with them. And so there was an urgency about that. And so it's in that time, then in the intervening time, as Mark said, we've received, and he'll talk about some of this a little bit later, but there's been a lot of guidance that's been issued. And what we've seen is a general liberalization of some of the rules in instances that's taken away some of that urgency. But businesses have now done everything that they need to do, and they're ready to get off of this roller coaster. And now there's just been this period kind of a lull, or maybe of inaction where we've had this urgency in the past. And so if nothing else, one of our goals today is to assure you that, this inaction or this waiting really is a course of action. And for most businesses at this point is the appropriate course of action as it relates to forgiveness. And we're going to talk about some of the other players involved, be it, government guidance via SBA and Treasury or Congress, who, we're waiting on some action or some items from them that will impact the appropriate way to move forward. In addition to that, one of the things, if we can maybe put you at ease associated with this, in addition to the urgency, is that there is plenty to worry about these days. There has been plenty to worry about in general as it relates to businesses and how they'll be able to reopen and cash flow. And there's been a lot of concern related to the PPP and how you'll be able to maximize that for your business. What we're wanting to do with this step back here is to say, okay, there are a lot of things that are on my mind. Which of these are actual concerns? Or which of these can we sort of check this off the list and say, yeah, it may have been a concern at one point, but we don't need to worry about that because of some of the guidance that's been issued. Let's get rid of the things that we don't need to worry about, take them off our list, and then focus on those few areas where there's still a chance to sort of move the needle, so to speak, and impact forgiveness. And so that's where these best practices come in. So again, as you're looking at all of these considerations that I've spent the money, but I'm concerned about my reduction in FTEs. Am I going to get full forgiveness? How do I handle this situation? We want you to keep in mind the following. Because of the move from 8 weeks to 24 weeks, many businesses are now in a situation where, some of these questions about what cost are good cost, what cost are not good cost become irrelevant. Most businesses, or many businesses, will be able to get full forgiveness by merely counting employee payroll good cost only. Now, Mark's going to talk about a situation later where maybe that's not the way to go based upon where we're at now. But generally speaking, that would be the most simple way to get forgiveness. And that's going to be available to most businesses. So again, a lot of these questions about, can I count this? Or we received maybe guidance that wasn't great about related party rents a couple of weeks ago. It may not matter because you likely will have enough good cost in that 24 weeks where you don't need to worry about those gray area costs. Secondly, if you have a reduction in your full-time equivalent employees, okay, or your FTEs, That's causing people a lot of concern. Say, okay, I've spent the money, but I don't know if my FTE count, I'm employing fewer people than I did last year. I know that's going to impact my forgiveness. How can we mitigate this? First and foremost, if your business, if that FTE reduction is related to a reduction in your business activity due to compliance with CDC, Health and Human Services, or OSHA guidelines, that gigantic safe harbor loophole, as we've termed it, then we don't even care about the FTE math. It doesn't matter what happens. You get to ignore that calculus when it gets to the application process, or that step 7. In addition, if you have a reduction in your number of employees that's not under that safe harbor, you still may be okay. You still may be able to count those people as employees, because not all reductions are created equally. If someone leaves you voluntarily during this covered period when you're spending down your PPP loan, or if you dismiss them for cause, those are not treated as a reduction in employees. So again, if that's the situation you're in, no need to worry about the FTE reduction. Finally, and this is one we're seeing more often, was that if you have a reduction in the number of employees, you don't for some reason fall under that loophole, and it's not one of these other reductions that doesn't count, such as the voluntary leave, the employee leaves voluntarily, or you dismiss them for cause, because these loans were based upon 2.5 months of 2019 wages, total payroll for the company, and you now have 24 weeks in which to count cost, there are situations where you can still bear a reduction in FTEs and a haircut associated with it, and still have enough good cost where it's not going to impact your forgiveness. So if we look at a simple example associated with this, we're going to go back to a plumbing company. Again, I don't know why Mark was the one that originally chose this. I don't think we're making any sort of implication about the PPP process and making some subliminal commentary on it by using a plumbing company. But anyway, we're going to use this as an example throughout. And let's assume this plumbing company had payroll cost of $432,000 in 2019. And we chose that because if you take 2.5 months of that salary, you end up with a $90,000 PPP loan, and you're going to see that number throughout. So let's assume that was the amount of your loan. During the whole of 2020, once the pandemic hit, the company is less business, it's operating at less than full capacity, it's had to lay 30% of its workforce off. So it's at 70% capacity, and by that we mean it's going to be running at 70% of the employees and 70% of the wages that it had in 2019. And it doesn't in any way, those were not voluntary reductions in employees. The company doesn't fall under the safe harbor loophole. Those are related to a reduction in business associated with the pandemic, but not one of those safe harbors. So, the business is in a situation where they have a $90,000 PPP loan. They know they have 30% of their workforce gone. The concern is whether or not they're going to get full forgiveness. But let's run the numbers in this situation. So if we take 70% of the wages in 2019, okay, which is the $432,000, multiply that by the 70%, again, accounting for the 30% reduction, and then run that out over 24 weeks out of the full year, that's going to provide payroll cost of $140,000 during the 24-week covered period. If we say, okay, we have $140,000 of good cost, but we've had a 30% reduction in our FTE count, well, that's fine. Forgiveness is the lesser of our adjusted good cost, which would be $140,000 times the 70%, which gets you $98,000, or your loan amount, which is $90,000. So you've still absorbed a 30% haircut on your good cost, and you're still at a point where you're going to be able to maximize forgiveness. So again, if you're in this situation, let's run the numbers and just do the math. But you may not have the concern that you thought you had. And all of these questions about when do I bring people back and how do I bring people back, we can base that upon what makes sense for your business and not what we have to do just to make the PPP math work. And that's really where we want to be in this. So with that, then I'm going to turn it back over to Mark. Again, he's going to discuss sort of the next player in this, and that's where we are related to SBA and Treasury and guidance, and the guidance necessary to move forward and maximize your forgiveness.
Thanks, Jeremy. The good and bad news is that it's a pretty short list that we're going to cover here. There hasn't been very much activity since we last spoke to you in June. And the primary focus of the guidance that has come out has really been on the banks and helping them to set up the process of actually pushing go on some of these forgiveness applications. But what we've heard from most of our friends in the banking industry is maybe we can process one or two, but we're not really pushing for them yet. And we're still kind of in a wait and see pattern. So even from the back end submission part of getting our paperwork right, there's not a desire to really pull a lot of applications into the system at this point in time. And one of the big reasons for that is that the banks, like the accountants and the attorneys and the others advising business owners right now, are waiting to see what new guidance is going to come out and what Congress may or may not do with a supplemental round of PPP funding and how that layers onto the program. And whether they're going to automatically forgive certain loan balances, which is a concept that has been discussed. And so we really don't have much new to tell you as a result of new guidance from either Treasury or SBA since our last call. We do have a few things to highlight, if we can flip to the next slide, and most of them are good. So we had a rule out now that clarifies who is a employee owner. So this was a term that that the interim final rules that Treasury and SBA came out with had used to try to prevent a company who received PPP funds from manipulating owner compensation in a way that that helped achieve maximum forgiveness, but supported by owner compensation. And so there were some special rules that came out for employee owners. And the question is, okay, well, who is an employee owner and how does that apply to different business formats? And so the new rule that we have since our last call says that an employee owner that comes under the 5% ownership threshold, which was an arbitrary threshold they selected. And again, this applies to shareholders. So we're talking about a C Corp or an S Corp, that those are not subject to the owner employee compensation limits. Jeremy, I guess we still have an ambiguity on what happens for businesses that are legally organized as LLCs but taxed as S corporations. I think I know the answer, that we would think of those as an S corporation for this purpose as well, but that's not 100% clear, I don't think. But again, for most businesses, it may not even matter because there are likely enough employee, non-owner good costs for the 24-week period to cover the amount of the PPP loan. Other good news we received was we had this question that was out there, and we think it's answered. It's not as ironclad as Jeremy and I would like, I think, but it had to do with employees that received variable compensation that was driven by economic activity or sales. So in other words, commissions. So good news on this are bullet points 2 and 4 on this slide. So clearly, as we thought, bonuses, lost commissions, and hazard pay that were paid out by a company are treated as good costs. And the corollary on this that I think helped us feel a little bit better about people questioning whether they had a wage reduction, especially where they had a subset of their employees who were paid largely on a commission basis, is that they want to look at base pay, salary, and wages in calculating whether there has been a more than 25% reduction in pay. In other words, we think that businesses can ignore reductions in commission income in doing that calculation, which is a really big deal for many businesses that were concerned that they were going to have a more than 25% reduction, because widgets just weren't selling, and there was some subset of their workforce that was getting paid based on sales of widgets. The last thing that is mostly good news was that for purposes of calculating what retirement benefit payments might be considered good costs, if you are paying in your covered period costs that were accrued or relate to services provided in an earlier period, that's fine. But the one caveat to that, which makes it not as great of news as it could have been, is that prepayment. So if you're paying today for an expense that's not yet incurred, then that is not going to count as a good cost. So you can't accelerate payments into a retirement plan if those benefits are yet to be earned by the employees. So again, mostly good news. I'll let Jeremy clean it up with one piece of bad news, but again, to put this all in perspective, these are definitional things affecting what our calculations of good costs are or are not. And for most of you on this call who are concerned about PPP topics, you have already spent or will spend enough on things that are clearly good costs that some of these close calls become less significant to you. But for completeness, we do want to cover them for folks who are seeing it in the newspaper or who may have their business affected in a way where some of these definitions become critical to the computation of their good costs. So Jeremy, why don't you tackle our bad news?
Yeah, sounds good. And maybe if it's okay with you, we've got a couple of questions. So since some of this does involve owner-employee comp, that the two questions we have now relate to that. And so the first one of these questions is when you count employees at the beginning and the end. So in other words, when you're looking at the number of employees during the baseline period versus the number of employees during this covered period, are owners over 5% ownership included in the count? Mark, I was trying to find this. I could have swore that it was in one of the new FAQs. My understanding is they should be. The owner employees over this, you don't have to worry about the reduction in wages associated with them, I believe, depending on if they are over the 100, assuming they're over the 100,000. But they still count as employees for purposes of both the baseline period as well as the covered period. So yes, you do count owner employees regardless of the amount of ownership in your FTE count, is my understanding.
Yeah, I think so. Our special definition of owner employees is relevant because if someone's not an owner and employee and they were highly compensated, then we're including in good costs their total compensation. And once they have that owner employee status, then now there's a cap on the amount of wages that can be considered good costs.
Correct. And that segues really well into our second question here then. So we have an owner employee of an S Corp, 100% ownership, so they're obviously over that 5% limit. Can you count up to 100,000 annualized comp for them during the forgiveness? The answer on this, and again, this is why if you can avoid using this, and I'm not saying you can in this situation, but it simplifies the calculation if you can avoid employee owner comp. But the answer in this situation is it depends. Under the 8 weeks, you get the 8-week equivalent out of 52 weeks of up to 100,000 of income, assuming that their amount of wages in 2019 were at least 100,000. Because remember, we have the cap. Not only is it a cap of 100,000 on owner employees, similar to everybody else if we're using the 8-week period, but we also can't count more wages than what they had in 2019. So you could, if their wages in 2019 were under the 100,000, that would be your cap at the 8 weeks. And so yeah, in the 8 weeks, generally speaking, assuming you don't have to worry about 2019 wages, they're at least as high as they were in what 2020 wages are. then you get the 8-week equivalent of the 100,000 of annualized comp. The complexity comes in though if you choose the 24-week period, because if you choose the 24-week covered period, you are not going to be able to utilize more owner compensation than what you received the loan based on. So the loan was based on 2.5 times, 2.5 divided by 12 times 100,000. That is going to be your equivalent. So yes, you still get to use 100,000 of comp for an owner employee over 5%, but you don't get to use 24 weeks of 100,000 of comp. You only get to use 2.5 divided by 12 of that compensation. So you have that because they don't want owner employees filling the good cost bucket with more wages to them than what they received a loan based on, if that makes sense, as much as any of this makes sense. So anything to add? Did I state it correctly, Mark? Is that?
Yeah, I think you nailed that, Jeremy. And I think I think that here in a second, I saw one other question pop up from Grace about what costs we should count and what costs we should not count. So let's table that one maybe, and we'll get to our thinking here in a second on kind of how to, in a world where a business has an abundance of good costs, how do we think through which ones are the best to put down and which ones are the worst to put down, and how different businesses might approach that. So we'll hold that question from Grace and tackle it here in just a second.
That sounds good, because that's some situation where we've taken a stance on that, but as with everything with this, there are exceptions associated with that, and we'll talk through those. So back to the bad news. So related party rent, that was one of those issues that we've received a lot of questions about. Again, we have a lot of situations, a lot of business owners where the operating entity, the operating business is held and operated in one entity, and then the real estate is in another entity, and there are lease payments made from the operating business, which would have been the one that received the PPP loan, to that related entity for rent. And the question has been, do I get to count that related party rent as a good cost? And our answer has been to this point, barring further guidance, we think that's an acceptable good cost. Again, barring further guidance, particularly in situations where you can point to the fact that the lease payments that are being made is market-based rent. You know, if you were to lease that property from an unrelated entity, the lease payments would be similar. You know, it's similar to that. Then we felt pretty good about related party leases. They, in one of the two new IFRs that were released, answered this question and put a really big limitation on related party rent, where they said that rent paid to a related party can only count as a good cost to the extent of the mortgage interest owed on and attributable to the space being leased to the operating business during the covered period. So what they've done is they've said, look at the entity that holds the real estate. Did they make any mortgage interest payments during the covered period? If they did, you know, mortgage interest is a good cost. We'll give you that portion of the rent. It's as if they collapsed these into one entity and said, we're going to ignore the rent between related parties. We'll give you rent, but only to the extent you would have been able to take a mortgage interest payment as a good cost during that covered period. So effectively, in a lot of instances, that's going to greatly limit the amount of related party rent that can be treated as a good cost. But let's go back to my initial, comments about sort of best practices and how we want to handle this. Let's not worry about it if we don't need to. The good news is the expanded 24-week covered period in many instances mitigates the impact of any of these rules that limit non-payroll good costs, or just limit the definition of good cost in general, because we have 24 weeks in which to count cost, and these, again, particularly payroll, and the loans were based on 2.5 months, so somewhere between 10 and 11 weeks of normal payroll. So because of that, yes, this isn't great news, but this would have been significantly worse news if we were stuck with an 8-week covered period. And the fact that we have 24 weeks, we have a larger population of good cost to count. So again, let's do the math. And if you were going to if that related party rent made the difference, then that is going to impact your overall forgiveness or maybe some other decisions that need to be made. So again, bad news, but is a lot less concerning than what it was under the old rules. Now, this last item wasn't necessarily a bad news that was released in any guidance, but it's bad news because of what SBA and Treasury have not said. Anyone who's been on all of these calls previously, one of the main questions we get, and the questions that we're still getting today, if we've seen on the questions that we've answered, is related to calculations of a reduction in full-time equivalent employees. How does that work? If I have a reduction and it doesn't fall into the safe harbor, how do the rehire provisions work? I have to rehire them before the end of the year. Can I rehire them before December 31st? Do I just have to rehire them for one day? Is there a period of time that I have to do it? SBA and Treasury have said I can apply early before the end of the 24 weeks. In that situation, how do you count the FTE reduction? When do you count it? Do you have to go through the full 24 weeks? All of these questions. And again, that's why we're trying to ignore those questions by falling under that gigantic safe harbor loophole and looking at those FTE reductions that don't count. This is the main bit of guidance that we're still waiting on. And to date, Treasury and SBA have not provided that guidance. And so to us, in some ways, that's some of the worst news to come out of this guidance that we've received since the last webinar on the 25th, and that SBA and Treasury have been absolutely silent on these major FTE calculation questions. So that's the bad news. So to this point, we've looked at where the business owners stand and their thought process. Everyone wants to get off this PPP roller coaster, but there are conflicting items related to government guidance, what we've received and what we haven't received yet in particular, that may provide some tension there and make it difficult for business owners to hop off the ride at this point, or may give them reason to wait. So now we're at the last actor or actors in this PPP process, and that's Congress. So let's take a look at where we are associated with them. As of late July, and there's been an update to this in the last 24 hours, but in late July, Senate Republicans introduced multiple bills that were collectively known as the HEALS Act. Okay? And that was their attempt at starting negotiations for phase 4 of COVID relief. Now, the House Democrats had their own version and vision for phase 4 relief, which was passed by the House in May. And so this in July was to begin the process of reconciliation to get to a phase 4 COVID relief. Well, as you guys know, if anyone has watched the news, nothing has happened. Okay, these discussions have stalled. And the reason this is important is for a couple of reasons. One, for those businesses, a lot of what we're going to talk about today deals with those businesses that are, hopefully operating well, have been able to spend all of their good costs and are ready to get off the roller coaster. But for many businesses, the pandemic still goes on, and the struggles associated with the pandemic still go on. And so these businesses have run out of PPP money and are looking for ways to help them stay afloat for the rest of the year. And part of that would be an additional PPP loan, should those be released. And the HEALS Act does have provisions for that. In addition, for those that are looking to get off of this train, the roller coaster, and are trying to figure out whether or not they want to apply for forgiveness or not, one of the reasons we're recommending people to wait is because you may not have to apply at all. And part of the HEALS Act provides for simplification of the process. Specifically for those loans that are less than $150,000, it's automatic forgiveness. You basically attest that you used it for the right things, you skip the application process, and you move on. So again, a lot of businesses are waiting to see how that shakes out before they make a decision. But unfortunately, as of today, no progress, I say no, but I guess minimal process, as we state here, has been made related to this phase 4 relief. And again, look at the news from yesterday. Given the fact that this is stalled, we've seen a new bill come out from the Republicans. As it relates to the PPP and forgiveness aspects of it, it's basically the same bill that was offered in July, but it's been greatly pared down in other areas, and they're going to bring this to a vote. But if you read the news and look at it, there is very little chance that this bill is going to pass as is. It's basically the same bill as before, which is already significantly less costly than the House bill that was passed earlier this year. And it's been pared down even more. And so again, this is one of those deals where they're going to bring it to a vote, but I wouldn't expect any movement on this in any real significant way. So again, we're waiting on, as it relates to congressional action, point one that speaks to waiting on this process is that if you have a small enough loan, there's no point in going through this process because there is a chance that that will be covered by some automatic forgiveness provision. Now, if we move to the next slide, here's the other big issue, which we've really not discussed up to this point, but it is the major elephant in the room. This is the one that's vexed us from the beginning. You know, we'd hoped that we'd get an answer in one direction, and the IRS and Treasury came in and said, nope, here's how we're going to handle this. And this relates to the deductibility of the expenses related to forgiven PPP funds. So let's take a step back. As part of the CARES Act, the PPP was implemented, and specifically included in the bill, because Congress, a lot of members of Congress have expressed this intention, this was their intention, was that the forgiven PPP loans were not to be treated as taxable income. Okay, that was passed into law. The problem is that Congress was silent on how to handle the expenses and the deductibility of the expenses that give rise to the PPP loan forgiveness. So Treasury stepped in and filled the void and said, yes, obviously the PPP loan proceeds, even though cancellation of debt is generally taxable income, because of this bill, because it's explicitly stated in the law, in the code, the forgiven PPP loan proceeds are not taxable income. However, based upon prior IRS guidance and case law, code and regulations, if you have an expense associated with non-taxable income, that expense is now non-deductible. So because of that, we're in a situation where individuals have PPP loans, you know, they're trying to juggle how to operate their business during this pandemic, how to cash flow, how to optimize these PPP loans as part of that. And here we have in front of us a situation where if this isn't fixed, this could take a 30 to 40% bite out of the after-tax cash flow to the business associated with these PPP loans. And so in addition to that, not only do we still not know how much is the business actually going to pocket after tax, because as of right now, it appears you're still going to have to pay tax on these forgiven PPP loans via the elimination of the deductions associated with the expenses. So that's going to have a significant cash flow impact, and Congress has expressed an intention to forgive it or to fix it. But as you've seen, Congress has also shown an inability to get anything accomplished related to this. And so we have one point of clarification that's going to be really important as we plan the remainder of the year, and particularly how we relate and how we plan for PPP forgiveness. In addition to that, so I guess in two things. One, it's going to have an impact on tax projections, because again, as we're looking at what we're going to have to pay for projections, and Mark's going to get into this in a little bit more detail, this forgiveness is going to make us, or this deductibility of the expenses associated with forgiveness is going to have a major impact potentially on your tax projections. In addition, it may impact the type of good costs that you want to include on your forgiveness application, and Mark will talk about that as well. Finally, there may be a tax planning opportunity that we have to look at here. If these expenses are not forgiven, or if these expenses are not deductible, we may have some incentive to push back. Again, we don't know whether this will be the case, but whether we'll be able to do this, but we may have the ability to push back this non-deductibility of expenses until 2021. So in other words, this issue may also impact when it's optimal for a business to apply for forgiveness, whether it's 2020 or 2021. So with that then, I'm going to kick it back to Mark, and he's going to talk through an example that kind of hits on these items that I discussed conceptually and things we need to be thinking about as we look at year-end planning.
Thanks, Jeremy. So we've picked our plumbing company, carried through that example. So most of the numbers are carried forward from the earlier example. You know, we know that there are different size businesses on this call. And so for some people, it's a $90,000 PPP loan. And for other companies, it's a $900,000 PPP loan. So the magnitude, we can just multiply by 10 and think about it in the context of your business. But here we have a business who's kind of in one of these tweener cases. They're not totally devastated by COVID, but they're having a not very good year. Considering all the disruptions, they're still profitable. So normally they earn $150,000 a year after expenses. And this year it's looking like things are going to shape up from operations to be just $50,000. So $100,000 reduction in net income. The company's already paid in 20 grand to cover its first quarter and second quarter estimates, and they want to know whether they need to send in a check next Tuesday for the third quarter estimates. Again, they had a $90,000 PPP loan, and we're going to assume that they had enough good cost from payroll that they can get that fully forgiven, notwithstanding any FTE reductions, which Jeremy proved out on an earlier slide where we compared 90,000 to 98,000. So where do we find ourselves? The 90,000 PPP loan is not taxable income when forgiven because Congress said so. But as Jeremy just pointed out, the costs funded by the $90,000 become non-deductible because Congress failed to say otherwise. So when plumbing company files for forgiveness, it will identify the 90,000 of good costs, and any of those good costs that would be otherwise deducted on their return cannot be deducted. And as a result, the company's expected taxable income for the year is either, if Congress fixes the glitch, as we've called it, $50,000 of ordinary income on which the tax is around 17 grand. They've already paid in 20, and we don't need to send in a check next week. Or if PPP funds are produce non-deductible expenses, then we're going to have 140,000 of taxable income. And that's going to drive a tax of $49,000, which means we have a little bit of work to do to pay in enough for Q3. So you see from this simple example that we find ourselves at this crossroads where unfortunately we want to know the answer to the question of are these funds going to be deductible or not? And we're in a world where we just don't know the answer. And it's getting to the point in the year where expected income for the year might be coming into clearer focus, and people are trying to figure out what tax checks need to go in for Q3 and Q4. And so we're going to have to make some educated guesses and assumptions with our clients and look at it kind of here's what it is with deductibility, here's what it is with non-deductibility, and decide on approach or kind of take a middle road for some clients. So that puts some numbers to those concepts that Jeremy talked about. And if we can advance to the next slide, let's think about a decision point that this company may have. So because the rule causes expenses that are funded by forgiven PPP dollars to be non-deductible, that's the current position of the IRS and Treasury, then we have this situation where we have some good costs that are not deductible at all for income tax purposes ever. And so if you'll recall, part of many businesses' PPP loans, especially for entities taxed as partnerships or sole proprietorships, we have and you'll see here that we intentionally made Plumbing Co. and LLC taxed either as a partnership or a sole proprietorship. For those entities, part of their loan was net income replacement based on 2019 self-employment income. And that was based for businesses that filed as a sole proprietorship and filed a Schedule C. the rules that we've covered in previous sessions said, hey, you got to look at the bottom line net income of the partnership, or I'm sorry, of the sole proprietorship for 2019. And that becomes a cap. If it's less than $100,000, that becomes a cap on the amount of loan that's supported by the profitability in 2019 of the sole proprietorship. So here, let's assume that we qualified for about the full amount. So 20,000 of our 90,000 loan was supported by the normal profitability levels. 150,000 is what I told you, of the business generally. And so we got a loan for 20,000 that was supported by 2019 net income, and we got a loan for 70,000 that was supported by our employee wages. So if we pick the employees' salaries to claim as our good costs, then all of those employees' salaries become non-deductible, and we were looking at about a $49,000 tax bill. But what if instead we select the $20,000 of self-employment income replacement, for which we were never going to get an income tax deduction because it was not a deductible expense, and then we select 70,000 of salaries paid to our employees as for the balance? Query whether we would come up with a better result. 70,000 of non-deductible on the salaries. There was never a deduction for the 20,000 of self-employment, and so there's no tax attribute to make non-deductible there. So one school of thought would be, no, if you've picked the 90, once you get forgiveness on 90, we're going to find 90 of costs that would be good costs and limit them. The other school of thought, which is what we're presenting on this slide, is that by deciding which costs we include on our forgiveness application, we are controlling the outcome and limiting the amount of salaries and wages paid by the business that would be subject to this non-deductibility rule. So flag this with an open question mark when we distribute the slide decks. We don't know the answer, and it's all dependent on whether Congress fixes its deductibility glitch or doesn't. But the takeaway is that we may want to pick and choose differently which costs we include on our application and which costs we do not in a world where we have abundant good costs. We may want to approach that differently depending on the answer to Congress's deductibility glitch. And as Jeremy well described, there's no urgency other than our nausea from being on this roller coaster for filing for forgiveness. So why not wait to see what the answer to the deductibility question is, and then we can make decisions on what is the optimal, what are the optimal classes of good costs to put on our application. So that's the takeaway from this plumbing company example here. So I'm going to kick it back to Jeremy, and he's going to put a bow on those concepts for us.
Yeah, thank you, Mark. And before we move on, let's circle back to the question. So what you said, I think, gets at the question that Grace asked earlier. So the question was, I've listened to various webinars, and some are still saying to use rent, utilities, et cetera, first, since those costs are easy to identify and document. I believe many think if they pay enough wages to just do wages. So what's WK's input? And I don't think it's changed a lot from where it was in our last webinar, which was putting aside what Mark just talked about, and then we'll circle back to that. You know, in our mind, perhaps the easiest thing to do really was more from a communication standpoint was if you have enough non-employee payroll good costs to cover it, just use those. You're only tracking one type of documentation in that case. You know, you're going to need payroll records and payroll reports, which shouldn't be too difficult to gather. And, you know, if you get the hypothetical, you know, reporter coming and asking your business, you know, how you use your PPP funds, you could say, in all honesty, that you spent the proceeds entirely on your employees. You know, it was more coming at it from that point of view. There is no right or wrong answer associated with that. You know, I think our position has been, it simplifies the process because those have to be you're going to have to use mostly payroll cost anyway. And so it saves you the trouble of having to get the other type of documentation, easy though it may be to collect. And it just gives you a nice, simple answer to the question of how your business utilized the PPP proceeds. The one caveat to that is what Mark just talked about, is that there may be some situations where you have the example like the plumbing company, LLC, where we may want to use the owner income replacement as a portion of this to get around the non-deductibility issue. One other question came in associated with this that I think it may be missed, and so it's worth mentioning, related to our not-for-profit. So the question was, if the PPP loan forgiveness is considered taxable, would it be considered UBI? And I think part of this is that Mark and I, as we talk about this, at least I'll speak for myself, a lot of times I refer to it as, I say for all intents and purposes, the PPP forgiven loan is taxable. That's true. That's the outcome we get to with the non-deductibility, but the mechanics are different. So I don't think not-for-profits have a concern about UBI, because the loan forgiveness is not taxable income. So it's not an income issue. It's just for these not-for-profits, some of their expenses that would have otherwise been deductible on the 990 will no longer be deductible, is what it is. So unless those were expenses that were used to offset UBI, it doesn't appear that the income itself will have any, that this will cause a UBI problem. So unrelated business income problem for not-for-profit. So just wanted to circle back to that before we put a bow on this. So here's where we've been. Mark has said it correctly. All of us are a little nauseous from this PPP roller coaster. Everyone's ready to get off the ride. The problem is a lot of business owners are concerned that they may still need to take additional steps to get full forgiveness, assuming that they don't meet one of those big safe harbors or have the employee, or the FTE reductions aren't ones that are ignored for purposes of the calculation. And let's always start with that. Or that they don't have a body of good costs that are enough to absorb a certain haircut associated with FTE reductions. So they have concerns. The problem is we still need guidance to implement how to get around these concerns. We still need guidance from SBA and Treasury on how to navigate that, and we don't have that yet as it relates to large questions, particularly those related to the FTE calculations and the rehire provisions. So we need that. In addition, we're waiting on Congress, because Congress has promised simplification for many borrowers, again, particularly those at a level whose loans were below $150,000. In addition, we've got this issue that Mark just walked us through related to cash flow and other concerns related to the potential lack of deductibility for PPP expenses. All of that is going to impact how businesses apply for forgiveness. So when we take those three actors and all of their concerns and what they've done and what they haven't done, here's where we're at. So here's what we're saying is our best course of action. For the majority of businesses, the best option is to wait, to just take our time, take a deep breath, and wait to apply for forgiveness and not rush into the process. There is no benefit to being first in line. And we think back to the application process, and there was one benefit, at least at the time, to being first in line, and that was a limited amount of PPP funds. But, with the benefit of hindsight, we look back and there were a lot of difficulties and concerns and confusions for those individuals that jumped to the front of the line in the application process, because guidance was still developing. And so applications had to be redone, or applications were provided that maybe, provided a loan amount that was less than what the actual maximum loan amount would have been. Because again, everything was evolving, and we're still kind of in that process as it relates to forgiveness. We've received a ton of guidance, but the guidance is still evolving. We're not waiting on the funds. The business has already had the use of the funds and is using it. So there is really no benefit or reward to being the first person in line for forgiveness. And as a matter of fact, being first in line may in fact actually be detrimental. Again, what I just mentioned related to the evolution of rules and all of the complications that come with that. Again, if we think about how the application process went. In addition to that, if you're one of those businesses that let's say Congress does pass a simplified application process or an automatic forgiveness process for certain businesses, if you've gone through the process now, you've engaged in unnecessary work and possibly unnecessary cost to do a forgiveness application where if you had just waited, you would have received automatic forgiveness. In addition, if Congress doesn't fix this problem related to the deductibility of PPP expenses, there may be an incentive for businesses to apply for forgiveness in 2021. So let's think about Mark's example. Here's what could possibly happen. Let's say Congress does not fix the deductibility of PPP expenses. So the company, it has in his, that second version of his example, $70,000 of non-deductible PPP expenses. Well, what can the business do? It can either apply in 2020 for forgiveness or it can apply in 2021. If the business applies in 2020 for forgiveness, then as things currently stand, it's pretty clear. The business is going to show a $70,000 of reduced expenses or additional taxable income in 2020 of $70,000 related to the non-deductible PPP, non-deductible expenses paid for with PPP funds. No doubt about it. They received their forgiveness in 2020. That's when they received the loan. That's when the expenses were paid. It's a 2020 income item. Let's say the business, though, on the other hand, waits until 2021 to apply for forgiveness. There are two things that could happen in this scenario. One, Treasury could come out and say, yes, we know you applied for forgiveness in 2021, and you didn't receive a determination of forgiveness until 2021, but you received the loan in 2020. The expenses associated with that forgiven loan were 2020 expenses. We're still going to make you pick that up as income in 2020 or as reduced expenses in 2020. So we're no worse off than what we were if we received forgiveness in 2020. But there is a chance if things end up the way they are and Congress doesn't fix this, Treasury could come out and say, because there was no determination of forgiveness in 2020, you didn't know, it's okay to deduct the expenses as incurred and paid in 2020, and that non-deductibility of expenses does not hit until the year that you receive your loan forgiveness determination, in which case it would be 2021. So by waiting until 2021 to do this, worst case, you're no worse off than you were if you applied for the forgiveness in 2020, other than you have to stomach the roller coaster for a little bit longer. Best case, maybe you've moved the pain of that non-deductible expense from 2020 until 2021. So that's something that we're just going to have to work around and keep in mind. And the thing to bear in mind in all of this is that the earliest that any application is due, in other words, the earliest that any of these loans, to the extent they are non-forgiven, you would have to begin making payment on them. And this would be for those individuals that use the 8-week period and receive their loans right at the beginning. The earliest the application would be due is in April of 2021. So we still have a significant amount of time with which to make these decisions. So a certain amount of patience is what we deem to be the best course of action. And with that, I'm going to turn it back over to Mark and we'll finish this thing up talking about what it is that we should be doing in the meantime.
Thanks, Jeremy. So as you say, patience is the name of the game, and it's a little bit unsettling as you framed from the outset, in a world where everyone was racing to get their applications for PPP funds in time to make sure that they got the cash actually awarded and received it in an amount of time where they could deploy it to mitigate what we hoped at the time would be the short-term disruption of COVID. It feels disconcerting to say, okay, let's just wait. But for all the reasons you've said, someone who rushes off to claim forgiveness now is going to lock in which good costs they claim, and which good costs they claim may be something we want to tinker with in the future if there's an abundance of good costs. and they might be doing work that they don't need to do. If Congress comes up with an auto forgiveness, and we have the number here on the screen, 150,000, which has been the proposal from Congress for this idea of automatic forgiveness, is let's just get the small loans forgiven. That'll take care of 80 or 85% of the loans issued. That will drastically decrease the amount of paperwork small businesses have to do and the banks have to process. And then that will leave the 150,000 and up loans, the larger loans, to have increased documentation and potentially increased scrutiny, and that seems to make a lot of sense. Possible that gets done yet. And so we'd really hate for businesses that are below that threshold, such as plumbing company LLC in our example, to spend a lot of time or pay accountants money or do any of those sorts of things to try to get off the PPP roller coaster when they may be getting a free pass anyway. And then, as Jeremy referenced earlier on, one of the really confusing things about the PPP program is this question whether someone actually has a FTE problem or has to think about it. We received a question earlier that we responded to in writing, not verbally for everyone to absorb, but Tom asked where there was specific guidance on employees who voluntarily leave. And the answer from Treasury is include them in your base period count, and if you haven't replaced them, then add them back to your covered period count. Pretend like they didn't leave, and so that's a path to think about this FTE problem. And I think, as Jeremy well illustrated, you can use a business that has a rough sense of, I think we're down 10% or 20% or something like that. You can do some pretty quick back envelope math that says, okay, well, if your PPP loan was $90,000 and if your payroll for the 24-week period is $140,000 and you've suffered a 10% or 20% or 30% reduction in your FTEs, maybe we have to document a couple of things, but it's not going to change the answer. You're going to get full forgiveness anyway, because Congress extended the covered period from 8 weeks, where we were anticipating a scarcity of good cost, to 24 weeks, where we have a potential abundance of good costs. And so, it's certainly the case that a follow-on PPP funding could potentially upset these rules and turn that way of thinking on its head. But we don't want businesses worrying if they have an FTE problem. And as we talked about on our June call, a lot of businesses are going to be able to point to this gigantic safe harbor loophole that says if your business has had a reduction in business activity that's related to OSHA, CDC, or the like guidance, then that's going to absolve you from an FTE problem, even if your FTEs have reduced from 100% FTEs in your base period to 60% FTEs. And even if the math, the back envelope math that Jeremy ran through, where we were comparing $98,000 to $90,000, even if you'd be okay there, the simplest answer is we don't even have to think about it, because we can point to that loophole, and that loophole then lets us take advantage of the EZ form, which has the benefit of a business not even having to report anything about their FTE counts. So again, those are the two items I think to focus on, and the slide here has them correctly ordered to say, first, let's look at the gigantic safe harbor loophole. Second, let's look at whether it applies, whether we have enough good cost anyway. And for some companies that maybe are feeling like there's some ambiguity whether their reduction in business activity was really linked to CDC or OSHA or those types of entities' guidance, then, I think they can get some comfort in potentially taking the position that they do, knowing that even if they filled out the long form, they get to the same answer. I think that someone who's in that boat feels a little bit more emboldened to use the short form, easy form, to claim forgiveness under the gigantic safe harbor loophole, even if there's still a little bit of ambiguity about exactly what that means. All right, Jeremy, let me kick it back to you.
Yeah, thank you, Mark. So, if as we've talked about throughout this call and throughout the process, is that there is it is certainly unsettling to be at this point where we've rushed to this point, and now everyone is advising to slow down, and so we're saying, okay, what is it that we can do in the meantime? And so, as it relates to this application process, even if there is a simplified application process where you don't have to submit all of the documentation, you are going to be required to maintain the documentation. So again, as we work through these other items, there is nothing wrong with beginning to gather the information that's going to either need to be maintained or submitted with the application. So quarterly payroll reports, for example, we know payroll is going to be a big part of this. That is something that could be done in the meantime, even without filling out a complete application. Finally, I think the thing that we would like you to take away from this is this process has been confusing. There are still a lot of questions. Let's focus on the questions related to the PPP that will matter and move the needle. And let's remove a lot of these other items from the equation and focus first and foremost, so that you can focus first and foremost on remaining business operations, business operations and cash flow for the remainder of the year. Again, we're still working within an economy that's not fully open. Even in those situations where it is, we're dealing with individuals that may be less likely to do certain things and to engage in certain activities, be it eating out or visiting local retail establishments, whatever that may be. They may be less likely to do that than what they were before. So again, trying to figure out how to position your business to best weather this remaining storm and to thrive needs to be the concern for the remainder of the year. And yes, we need to be mindful of the impact of these things that we've discussed on it. I don't want to minimize the cash flow impact of the potential tax on these PPP expenses. Okay, so we have to be mindful of that, but let's worry about what we need to worry about and try to remove as many of these little items as we can from taking up, valuable mental, time and energy on your part in worrying. Because again, there's plenty to worry about, related to business operations and how to do that responsibly and how to do that in a time when we're still dealing with a pandemic. And goodness knows if we have parents on the phone, classes have just started back up. So how will it impact you? How will it impact your employees if we get to a point where we go back to online learning, and we're still seeing online learning, for example, in Colombia? All of that are things, that we have to worry about. Let's try to minimize the amount of things we have to worry about related to the PPP. And again, focus on those few things that still will move the needle associated with it. So I know that's a lot of information. I know that we are all ready to sort of get off the PPP roller coaster. As Mark said, there's a certain degree of nausea that's been included with it. I will say this, we do appreciate you allowing us to be on that ride with you, though. We will continue to be on that ride with you throughout this process. I think we're shaping up it's going to be a pretty active end of the year for all of these reasons we've talked about. We have an election coming up. There's just a lot of uncertainty. And so we've appreciated the opportunity to be with you through this, and we will continue to be with you throughout whatever comes in the remaining time this year and the remaining years ahead. So with that, I think that's the end of our formal presentation. We do still have a few questions. The first one is on the gigantic safe harbor loophole. If there was no mandatory guidance, no mandatory shutdown from the state or local government or from CDC, but suggestions which were followed by the industry. So this is related to a college or to send students home and go online. would that qualify or not? Mark, I don't know if it was due to best practices, but not due to a local shutdown. I'm not entirely certain that I would feel 100% confident that it would qualify.
Again, I think this is what the ambiguity that I was referring to,
okay.
Where if you had a close case on this question and you knew that you were going to get the same forgiveness answer either way, then I might be more emboldened to take the approach of taking the position that we meet the safe harbor, knowing that, if somebody said, no, you didn't, we'd say, okay, well, here's our paperwork and see if we get to the same answer anyway. So the requirements in order to fit within that safe harbor are to be able to demonstrate that the reduction was due to compliance with requirements. But again, we don't want to conflate shutdown with requirements. So the requirements could be a requirement to sit students 6 feet apart. Correct. And that those social distancing types requirements, even though they didn't in and of themselves drive a shutdown, perhaps showed a decrease in business activity that rises to the level of fitting us within the safe harbor. So, it's things related to the maintenance of standards for sanitization, social distancing, or any other worker or customer safety requirement. So I think that the answer is in the questioner's particular situation, that those suggestions that were followed may have had underlying requirements that caused that to become the best practice. And so we I think want to think through which of those specific safety requirements that were being implemented caused the conclusion that it wasn't going to be possible to maintain everybody in a safe environment without that shutdown.
Yeah, I think that's a good clarification because, I mentioned shutdown, but, obviously the biggest example of those industries that would be utilizing the gigantic safe harbor, would be our friends in the restaurant industry. In other words, those that were, even if they didn't fully shut down, they were operating are still in some instances operating at reduced capacities or only doing curbside takeout and not seating in. The restaurants themselves may have been opened, but they had a significant reduction in business activity due to conformity with these guidelines. And so they would fall under that gigantic safe harbor. These final questions relate to how to account for the forgiveness. So if you wait to apply for forgiveness until 2021, will the PPP be reported at year end as a note payable? I think it would be. That would be the consistent treatment of it. In other words, if you've not received a determination yet associated with the forgiveness, then at year end, you still had a note. Now, if we get to a situation where the IRS says, or Treasury says, we know those amounts are going to be non-deductible. Well, I don't know that matters. I was going to go, if we knew guidance where maybe the non-deductibility hit in 2020, you would go ahead and run that through as book income in 2020. I don't know that there's a relationship between those. So I don't know. In that case, I think I would still report it as a note payable versus PPP loan income, unless, as of the time, if, for example, if you're having reviewed financial statements, potentially, maybe if you have that determination in 2021 early enough, maybe you go ahead and accrue that income back on your 2020 financial statements. I don't know that we really have firm guidance associated with that. Anything on that one, Mark?
I think you've covered it there, Jeremy. I think in the background, we have this rule that says if you don't apply for forgiveness before the 10-month due date, which we've told everyone not to worry because it's in April at the earliest for anybody, but just thinking about the year-end process, there's still that theoretical possibility that a company wouldn't have filed for the forgiveness in time, and then conservatism would have us not remove the liability, even though we think that all the events that needed, in other words, to result in forgiveness have been satisfied. So I agree with your reaction, Jeremy, that for both GAAP and tax reporting, having it as a liability at the end of the year would be the result. And I think that leads us to another consideration to at least talk through and make sure that if you have any borrowing covenants that are tied to your balance sheet ratios of leverage or things like that, that's part of the discussion on the timing of forgiveness, and discussions with your lender of, if the PPP loan is what trips you up and there becomes a tax reason to defer, whether that is something the bank can work with you on, or whether whether the tax and financing considerations are at odds, and business owners are going to have to choose between pulling it into income, getting that into equity, pulling it out of liabilities before the end of the year, or whether that's an arbitrary cutoff and the bankers don't really care. So I think, again, that's only going to affect businesses that have lenders who are looking at their year-end ratios, leverage ratios specifically.
So next question, we're going back to the tax side of things. So let's assume taxes are filed on a cash basis. You do not receive forgiveness for your PPP loan prior to the end of 2020. They are asking trying to confirm whether you will not need to recognize those additional funds because they would not be considered revenue at that time. I think that, well, let me go back, because I'm more clear on this than maybe what I was earlier, in that the loan, if you don't receive, in no circumstance will the loan forgiveness be deemed to be income, regardless of when you do it. I think it's still an open question as to whether those expenses would be deductible or not in 2020. I don't think we can give you certainty today that even if you're on a cash basis, because you don't receive the forgiveness until 2021, the Treasury, and the IRS isn't going to come back and say, look, the expenses were paid. These relate to expenses that were paid last year in 2020, and they are non-deductible because they are associated with income that's non-taxable. So, I mean, there is a certain amount of consistency with what you're suggesting, is that, that's what the forgiveness doesn't happen until 2021. So the non-deductibility shouldn't happen with 2021, but I would not assume that with 100% certainty, regardless of the methodology you use to file your tax return.
Yeah, Jeremy, I think that's where we're saying that's the timing of the resulting non-deductibility, if that's where Congress leaves us, is a giant open question. And my perception has been the majority view is that if you had expenses paid and incurred during 2020, that you later in 2021 claim forgiveness with respect to, that we would need to hold the income tax return for 2020 until we know which costs are used and which ones aren't, and can calculate what that adjustment is, and put that adjustment back on the 2020 return, so there's a matching to when the expenses were incurred. I think that's the majority view, but there's this idea out there that for simplicity, Treasury might come up with a different rule that lets us link the non-deductibility to the year of forgiveness and pick some expenses that are incurred next year to apply the non-deductibility to. And so that line of thought is out there, and we noted in the presentation to just say there's no one putting a gun to our head and saying we need to apply now. So let's wait. Let's wait and see what Congress does. Let's wait and see what the next few months hold. And hopefully Congress makes this all a moot point by causing the PPP funds that Congress intended to be non-taxable without a impact on deductibility. That was, I think, their clear intent, and many senators at least have said as much. When they budgeted the impact of the CARES Act, they did not budget any revenue increase for the non-deductibility of costs funded by PPP dollars. So I think that was their clear intent. They got the language wrong, and so we're going to see if they can fix the language in time.
Okay, last question. Do we start paying the interest on the PPP loan since it's not advisable to apply for forgiveness yet? And I was looking at trying to find the FAQ, and I didn't get to it quickly enough. But I don't believe there is any requirement to begin paying either interest or principal until 10 months after the end of your covered period. So yes, interest will continue to accrue, but to the extent your loan is forgiven, the interest associated with the forgiven portion of the loan is also forgiven. So I don't see that there's any incentive to pay interest at this point unless you are planning on a significant portion of your PPP loan being non-forgiven. So did I state that correctly, Mark?
Yep, I agree with you there, Jeremy.
So I think that takes us then to the end of our questions, unless anyone has anything else that they want to ask, going once, going twice.
So Jeremy, we've done it. I think allowed an hour and a half for this presentation. Is that right?
That is correct. I don't think we've hit our time deadline in any of these previous ones.
We certainly have not. So again, we thank everyone for their attentiveness. If you have questions that pop up, please don't hesitate to ask. We're here to try to help make this as unnauseating as it can be. But I think our real takeaway, Jeremy, if we were condensed this down to a 30-second soundbite, is we had a whole bunch of new rules in June. We figured out what those meant. We have a whole bunch of unanswered questions that make it hard to apply for forgiveness now and potentially unwise to apply for forgiveness now. And so our advice to everybody is, as much as we'd all like to be working on these forgiveness applications and getting it behind us, the prudent thing to do seems to be to wait for another 4, 8, 12 weeks and see what rules we're left with. And so we'll continue to monitor that and to communicate with you, our clients and friends of the firm, and try to make sure that this disconcerting quiet of everyone rushing to get their money and then waiting to figure out what forgiveness means, that we hold up. That we all feel comfortable, I guess, is a way to say, in that silence. I was just looking. Ryan, one of our audit partners, shared with us some AICPA technical guidance that we will also include in the materials that we provide access to, that really address this question of what do you do with on a GAAP basis? What do you do with a loan where a PPP loan where you really know the answer, it's going to be forgiven, but the final detail of requesting and having forgiveness approved has not yet happened yet. So we'll share those materials for those of us who are, for those of our listeners who are on the GAAP basis of accounting, so that you have the most up-to-date thinking on that question as well.
So with that, I think it doesn't appear we had any more questions. Everyone, thank you for your time and attention today. Thank you for, letting us work with you through all of this. Stay safe, be well, and we will continue to be in touch. Thanks, everyone.